This is CGTN, China Global Television Network.
Hello there, welcome to this edition of Global Business Africa. In the course of the hour, we'll run through all the business news stories you need to know about from across the continent and beyond. Let's start with a quick run through the market here for you. So the NSE 20 in Nairobi has had an absolute riot this week. In fact, for the last 1 month as a whole. In the last 4 weeks, it's up over 11%. In today's trading session, up by over 3%. A big chunk of that is coming just from two main places. Investors loving the story coming out of Safaricom, and of course the bank stocks essentially gaining off the back of efforts to essentially repeal the rate caps that have essentially killed off flow of credit to the private sector here for the last 3 years. Here's what's coming up tonight. AfDB shareholders approve its largest capital increase in the bank's 55-year history. The World Bank is warning Kenya against introducing new punitive taxes. And Apple has finally entered the streaming wars. We'll look at their entry shortly. But tonight, let's start with a question of capital. The African Development Bank's Board of Governors have approved a capital injection of $115 billion. That is the most substantial capital boost ever since the bank's establishment back in 1964. The decision to increase capital comes after 2 years of negotiations to give the bank a much greater capital base to meet Africa's funding needs. Now, the boost ideally should help the AfDB maintain its AAA rating. It's also expected to improve its capacity to finance infrastructure projects of many different kinds across the continent. The 124% increase in capital represents improved confidence from the shareholders. Now, that is, of course, the 54 African states and 26 other non-African donors. AfDB now has a capital base of $208 billion. The previous number was just $93 billion. Some company news now. Safaricom has reported a 14.4% growth in half-year net profits to over $345 million. Pre-tax profits were up by 12.7%. Service revenue was up by 5.3%. So you're looking at $1.2 billion in that particular sector. The 5.3% revenue growth was attributed to a relatively strong performance across M-Pesa, that's the mobile money service, fixed data and strong customer growth too. Now, the increase does offset, however, a decline in traditional revenue streams and the weak performance on mobile data revenues. Voice revenue was down 1.4%. Messaging revenues were down by 11%. Voice and messaging combined made up 44.6% of service revenues. M-Pesa remained relatively strong during the period. It was up by 18.2%. That growth was attributed in part to the 12.4% increase of 1 month active M-Pesa customers to hit 23.6 million clients. Right then, South Africa's rand did firm up a little bit on Friday ahead of a long-awaited decision on South Africa's credit rating. Moody's credit rating agency is set to announce its decision following a review of the country's economy. Now, the rand was at around 15.06 to the dollar, about a third stronger compared to the previous day's close. The currency had been losing ground in the wake of a very bleak budget speech on Wednesday, where the finance minister, Tito Mboweni, slashed growth forecasts and predicted that the deficits and the debt would be rising. That in turn did raise fears that South Africa could lose its last investment-grade credit rating. All right, a fair bit to get through on this. So let's join Angelo Coppola. He's live in Johannesburg with the latest on this particular story. Angelo, what is the market expecting to hear from Moody's today?
Well, market participants, analysts, economists, and anybody that you would care to ask were nervous about what was going to be happening. The outlook change was expected. In fact, that isn't what's been expected by most of the pundits and commentators at the very least. So that outlook from stable to negative, that's what everybody's expecting right now. You'll of course know that 2 of the 3 major agencies have already put South Africa into junk status territory, and they have been there for some time now. The worst case scenario is that there is a downgrade announced. Not sure what happened, of course, to the local market. That rand US dollar spot price suddenly began strengthening in about 5 minutes to 5, and either somebody is doing some short selling or was doing some short selling, or someone got wind of something on the wires, for example. Either way, the spot did move in the right direction. The JSE was also marginally stronger on the day, so no news just yet. Of course, you'll recall last time that Moody's was meant to make an announcement. They didn't make one, which meant that the outlook stayed the same and the rating stayed the same. So nobody knows what's going to happen just yet, Raman.
Indeed, but let's assume the worst case scenario here, right? Because given that it will take a fair bit of time, years in fact, to turn around South Africa's public finances, have bond traders already started to price in a future downgrade from Moody's?
Well, look, as it stands right now, the South African 10-year bond yield is almost 3 percentage points higher than the lower rated Brazil. Brazil, of course, you'll know that they're in deep trouble there at the moment. Market pricing is also indicating it's only a matter of time before Moody's comes in line with its other agency competitors. The experts are saying, though, that the cost of insuring South Africa's debt for 5 years using, for example, a credit default swap is more than double that of Russia, which has also got a similar rating to South Africa with Moody's, and it's higher than Brazil's, which is rated at junk. So, you know what, the bond market is moving around quite substantially at the moment, Raman.
Indeed. One last question for you. At a time when Greece of all countries, and Germany, they're both issuing debt with negative yields, South Africa's fixed income notes do look pretty attractive. Yields of 9% are nothing to sniff at when other countries are offering you either negative yields or 1% to 2% at best. But would they still be attractive in the event of a downgrade?
Well, Raman, as you know, it's all about the mandate that any of the institutional funds have. Government bonds, of course, as you know, will be the worst affected. They'll be sold off first because the mandates will trigger that automatic sell option when that country gets dropped into junk status by the third ratings agency. And that could cost, they reckon, South Africa around $15 billion in outflows from the country. And it's not negotiable. It's not something that the fund manager can negotiate about. The yields may still be positive, but won't be pursued because of that, again, that institutional mandate that is in place by most of the bigger players in terms of taking decisions. And those decisions aren't made by the fund manager in the traditional space, of course, but there might be some venture capital or other hedge fund players who might be keen to get involved in those government bonds with those high yields because they'll see there's a higher yield, but of course there is a higher risk, so they might start playing in there. As I mentioned before, that 10-year bond yield is almost 3 percentage points higher than Brazil, for example. So people with an appetite, without a mandate, could get involved there, but for most cases they won't get involved because the mandate dictates that. Raman.
Indeed. We'll wait and see how this all plays out. Angela Coppola in Johannesburg. Thank you. Now, Sudan has agreed to a roadmap to rehabilitate the country's economy with multilateral institutions, 3 of them, in fact, the World Bank, the IMF and the African Development Bank. The country's finance minister, Ibrahim El-Badawi, says the plan involves structural reforms, but it didn't go into details on exactly what sort of reforms are on the table. He said as part of the deal, Sudan would not have to pay its lenders' debt arrears either. There could be some non-financial support as well as part of the package. Sudan's inclusion on a list of countries deemed to be sponsors of terror by the US does disqualify it from debt relief and financing from the IMF and the World Bank at the moment. Egypt's first smartphone manufacturer, SICO, will start exporting its devices to Germany next month. Now, the move is part of its expansion plan to sell its products to Europe and Africa. SICO is a fairly new company. It was set up about 2 years ago. It has $12.4 million in paid-up capital. The company sells phones under the brand name Nile X. CGTN's Yasser Hakim spoke to the founder and CEO, Mohammed Salim, on its strategic plan. He filed this report.
It's only been launched 2 years ago, and the Egyptian mobile phone SICO is already targeting Europe. The founder and CEO, Mohammed Salim, tells me results have been better than expected.
Our European partners were very much enthusiastic for this step and to take our goods one step forward to Europe. So maybe, yes, this one was faster than we have planned to. We already signed an agreement with a distribution company in Germany to start with Germany and then to the Scandinavian countries, to Norway, Finland and Sweden. We took another step in Europe by exporting to France. This happened just yesterday. This is the first time that I mentioned this.
The local brand, which is a mobile phone and a tablet, has already been selling in the Middle East and Africa.
Actually, we are now present in the GCC countries. We have just started in Africa by having our first shipment to Côte d'Ivoire or Ivory Coast. Actually, this one has developed very much fast, starting from spreading our marketing material over several markets in Ivory Coast.
40% of this Egyptian mobile brand is locally manufactured. The rest of its components are imported from China and assembled in Egypt. The company is planning to increase the local components to 60%. What makes Seco competitive? What are the aspects that can make it compete with other brands in the market?
From the first day, we have the strategy of offering a very affordable devices for very good quality and giving the customer the full experience he deserves for the device he is buying from us. And this strategy is complying with all the African and developing countries.
What is your strategy and your dream of achieving for Seco in the next few years?
The dream or the goal is to be the largest electronics manufacturer in the Middle East and Africa. And here I am talking not only about mobile phones and tablets, we are talking about several electronics devices. So in our region, the digitalization, and there is a very obvious digital gap. So there must be several and different electronics devices to bridge this digital gap.
Yes, Hakim for CGTN, Cairo.
Quick run through some company news for you. Total's CFO says that the company still cannot confirm its final investment decision on the Uganda oil project. Total, however, remains committed to pushing through with it. The CEO says they have been held back by some unresolved issues with Uganda's authorities. Total's plan for the project includes buying some of Britain's Talos oil stake in the 230,000 barrel a day project. In South Africa, Taste Holdings, that's the owner of the Starbucks and Domino's Pizzas franchises in South Africa, says it's abandoning the food business altogether. It's cutting and running. The firm already has sold 13 of its stores in the coffee chain to a consortium for over $460,000. The company also said it is in discussions on the sale of Domino's and its two other food businesses, the restaurant chain Maxis and the fish and chips company, as part of a new strategy to become only a luxury retail group. In the tech world, the fitness device maker Fitbit is being bought by Google for just over $2 billion. The move will allow Google to essentially expand into the market for fitness trackers and smartwatches. It comes at a time when loss-making Fitbit has been looking to expand into other areas. Now, the bid essentially values Fitbit at about $7.35 a share. That's a premium of roughly 19 cents, or rather 19%, to the stock's closing price on Thursday. Its shares have gone up 40% since Monday. And finally, ExxonMobil's third quarter profit has nearly halved after being hit by lower oil prices and much weaker margins in its refining and chemicals businesses, and its three major businesses are reporting lower year-on-year profits. Earnings were down to $3.2 billion, about 75 cents a share in the quarter, from $6.2 billion, or about $1.46 per share, a year earlier. Exxon shares rose by less than 1% in pre-market trading on Friday. That's a run through your headlines. It's time for a short break. You're watching Global Business. Here's what's coming up next. The World Bank warns Kenya against introducing punitive new taxes. And South Sudan opens bids for 14 new oil blocks. We'll have the details when we return.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business, only on CGTN.
Every story starts out like this.
Okay, we'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible and why?
Let's get some reaction on ground. Joining us in Johannesburg is Sudan. Hello, Naro.
This is how all stories begin. See how they end. Only on Global Business.
An open platform to a market of close to 1.4 billion people. A new platform strengthening global economic cooperation. A progressive platform promoting innovative growth and inclusive development. Join CGTN and its integrated media teams as we take you to the second China International Import Expo in Shanghai. We'll show you how the expo reflects a new era of China's opening up, how it builds a shared future of global economic prosperity, and what this means for consumers, businesses, and policymakers. Only on CGTN.
Welcome back to the program. You're watching Global Business Africa. Now, the World Bank is urging Kenya's government not to rush into imposing more punitive taxes on companies in the tech and the finance ecosystem in its rush to reduce persistently high fiscal deficits that in some years have come very, very close to 10%. That at least is one of the key recommendations made in the latest edition of its review of the East African economy. But this is just part of the problem. You see, Kenya isn't meeting her own fiscal deficit targets. In 2014, for instance, the idea was to have a fiscal deficit of about 6.3% of GDP. We ended up with something much bigger, 8.1%. The fiscal year ending in June 2017 was actually the worst of the lot. The deficit in that year was over 9%. This year, the Finance Ministry has raised the deficit target twice to now stand at just over 6%. Whether or not they'll meet it is another matter altogether. So closing that deficit, at least from the government's perspective, means raising more revenue but not necessarily cutting expenditure. But there's a huge concentration risk there, and it all has to do with this number. You see, between them, telecommunications companies and financial services firms, basically Safaricom, Kenyan banks and insurance companies, they account for 6 out of every 10 shillings in income tax revenue raised by the state. So because the sector is large and relatively easy to track, it's very visible, it's been hit with wave after wave after wave of tax hikes. And this essentially will give you an idea of exactly what's happening. Just last year, excise tax on mobile money transactions was raised by 200 basis points to 12%. The applicable rate on voice, SMS and data, that went up by 500 basis points. And all of this, remember, is in addition to the 16% VAT that already is applied to those services. And who bears the brunt of these extra costs? You, the consumer. In essence, this is a classic golden goose problem. How high a tax rate is too much, especially when over 50% of jobs in Kenya are estimated to be susceptible to being lost through automation. I spoke to one of the report's authors a little earlier on, Casey Torgerson. We started by exploring how this rising tide of taxes may constrain not just the growth of e-commerce, but also investments in and the growth of the next wave of Kenyan tech startups.
Obviously, government needs to generate revenue, but for the time being, the main target has been sort of excise fees on broadband services, on airtime, on digital financial services. Those are sort of the first step in actually engaging the digital economy. We see that especially for price-sensitive consumers, that may be the sort of the line which they're not able to cross to actually pay for those services. You're also seeing heavy disproportionate taxation on the operators themselves, whether it's regulatory fees, taxes, etc. Again, that's a good source of revenue for government, but we think we need to take a longer term and broader view. So looking at the digital economy as a whole.
Governments seem to be very keen on trying to raise as much money as they can out of this golden goose, for lack of a better word. Kenya's proposed a tax on digital transactions. It's still going through Parliament. But when we step back and look at the broad picture here in terms of the digital tax problem, what's the pain point? Are we already at a point where we can say, well, we've already taxed these guys too much, let's just stop at this point?
It's hard to see where the exact tipping point is until you've actually reached it. So I think moving with caution, I think, is the word of the day. Making sure that you're not taking actions now that are going to have a longer term detrimental impact in terms of the overall economic growth in Kenya or individuals' opportunities going forward. So it's difficult to draw a specific line where this tax is too high versus too low, and government does need to generate that revenue. But I think as a general principle, we want to try to avoid as much as possible taxing sort of the access points to the digital economy, concentrating that revenue collection downstream in terms of the resulting economic activity.
What about the cross-border problem?
So that's a key challenge, and it's something that even developed countries haven't solved yet. I know the OECD recently released a new framework for taxation of the digital economy. It's still a draft framework, but it tries to tackle this issue of firms who are offering digital goods and services but are not necessarily domiciled in that country. And the actual goods and services they're offering are hard to quantify and to assess taxation upon. So I think it's something that's going to have to happen as a regional body or even a larger grouping. Kenya can't really do it on its own. It doesn't quite have the leverage on its own necessarily to take on some of the global players, nor does it want to risk double or triple taxation if each jurisdiction is applying taxes, which then may discourage those firms from actually entering the Kenyan market in the first place.
Investors come here and they say, I have capital, I'm not seeing businesses to invest in. I talk to people in the startup space and they're saying the complete opposite. We've got ideas, but we're not getting access to capital. So there's a funding gap somewhere in the middle here. Why does it exist? And is this an information asymmetry problem? Is it a culture problem? What's going on?
So I think it's a bit of all of the above. You're seeing both a lack of understanding on the venture capitalist side in terms of how the Kenyan market operates, and the same for the Kenyan entrepreneurs, not really understanding how to package their business propositions and their business proposals in a way that would actually attract that venture capital. You are seeing an increase in venture capital, so that is slowly starting to tighten, and you're seeing some success stories, and I hope that starts to spill over into the other entrepreneurs in that space. But fundamentally, there's a big disconnect between a lot of the sort of technical experts and people with good technical ideas, and those with actual business acumen who know to run a successful business. Maybe they don't even have a digital background, but if you can pair those two together, oftentimes that can be a much more successful venture.
Is there a taxation problem as well that stops these enterprises from growing into much larger ones? Because it seems there's a huge chunk of ideas or businesses at the idea stage and a handful of companies up here that have essentially grown, but there's a missing middle. Is that a tax problem?
In part, it's a tax problem as well. Startups typically do not make any profit for a number of years. That's the entire business model. So in theory, there shouldn't be any taxation assessed on that. But even if there isn't taxation, the bureaucratic processes are very time consuming for a small startup who's focused on developing their product, rapidly innovating and prototyping, may not have the time to actually deal with the bureaucracy. So and I've seen other countries where they have actually adopted the laws and regulations and bureaucracy around that to encourage startups, creating a more permissive environment for startups to help them get to that level where they can actually grow and then generate revenue for government based on their profits.
My conversation there with Casey Torgerson from the World Bank. Now, we're still in Kenya. The country's private sector alliance has signed a memorandum of understanding with Chinese and British enterprises. The agreement essentially aims to facilitate better cooperation among the three parties in promoting commercial ties between companies from Kenya, China and the UK. With the details, here's CGTN's Robert Nagila.
The Lake Turkana Wind Power Project, Africa's largest wind farm, located in northern Kenya, constructed by a European company in partnership with a Chinese power company. The Suswa substation, contracted to a Chinese firm by Siemens. These are just some of the examples of Chinese companies partnering with other countries and the private sector on projects in Kenya. Now, the Chinese Embassy, the British High Commission and the Kenya Private Sector Alliance have signed a memorandum of understanding to collaborate on future mutual beneficial projects.
The idea for we hold this reception is to establish the platform for private sector, not for officials. Because we believe that is your private sector play the key role to contribute Kenya's economic development.
The British High Commissioner in Kenya lauded the working relationship between her country and China, describing it as a win-win, saying Kenya would benefit from it.
We believe that the technical design, environment, contract management and provision of legal services that UK firms are known globally for, combined with the strengths that China has on construction, infrastructure and major project management, are a winning solution for us working here together in Kenya for the benefit of Kenya and Kenyans, but also our mutual relationships with each other and with Kenya.
Kenya is scheduled to hold a major summit in 2020 on jobs and the youth with donor partners.
We look forward to all the partners that are seated here today. What can we do to increase the jobs? As we do the investments, what other programs, what other projects can we do together?
The partnership is expected to contribute to job creation in various sectors of the economy and give impetus to Kenya's industrialization agenda. Bobet Nagila, CGTN, Nairobi, Kenya.
Africa's youngest country, South Sudan, is planning to hold an oil licensing round in the first quarter of 2020. The country's invited oil firms, in fact, to take part in the tender for at least 14 of its oil exploration blocks. South Sudan currently produces about 175,000 barrels a day of oil. It's still looking to scale up to reach its goal of 250,000 barrels a day of output. CGTN's Patrick Oyet has the details.
South Sudan's Petroleum Ministry says it will launch its first licensing agreement in the first quarter of next year. It says it has 13 blocks which are open for tender.
We're inviting all our investors who would want to invest in South Sudan to come and look into those blocks. As we move on, we're also trying to get some data and information, because for you to evaluate the blocks, you need to have some data. And our team is already engaged, and they have already been able to put up a data room that will be fed with the necessary data.
South Sudan's government says oil production in the country is now at 178,000 barrels per day, and that it hopes to reach 250,000 barrels per day in early 2020.
We believe that investment is a crucial pillar of peace. In the past year, the country has demonstrated that stability goes hand in hand with economic prosperity.
5 years of civil war destroyed some oil fields. A peace deal was signed between South Sudan's government and opposition groups last year. Relative peace has returned to the country, but Juba says it lacks money to implement the peace agreement. South Sudan's government is looking to oil money to try and fund implementation of the current peace deal. However, experts say for investors to put money into the country, sustainable peace will need to return to South Sudan.
We still expect more from you. We still expect you to do more in creating an enabling environment that we can vote with our wallets. We still expect from you to make it easier to do business.
China is currently the biggest investor in the South Sudan's oil sector. South Sudan's government says it hopes to encourage more companies from other countries to also invest. Patrick Oyet, CGTN, Juba, South Sudan.
Now, on to a rather curious trade dispute in West Africa. Aggrieved members of Ghana's trade union have shut down several shops owned by Nigerian nationals in the country's Ashanti region. Now, the move appears to be a sort of retaliation, if you will, to the closure of the Nigeria-Benin border. The union has been quite critical of the Nigerian government since it closed its border with Benin back in August. Now, the association cites that the closure is an outright breach of ECOWAS agreements. This is the second time this year that the association is shutting down Nigerian-owned shops. However, according to the association, its latest move is in response to the government's failure to enforce the law, which it says restrains foreigners from engaging in the lowest levels of retail trade. All right, then let's dig a little deeper into exactly what's going on here. CGTN's Nabil Ahmed Rufai joins us now live from Ghana's capital. So, Nabil, this traders union say that the law is on their side, but for context, for our viewers, tell us what the law exactly says and, according to traders, why it's not been enforced.
Ramah, the law actually says that the sale of goods or provision of services in any market in the country, or even petty trading or hawking, must be reserved for only Ghanaians. However, over time, we've seen foreigners, especially Nigerians, coming into the country to do business. There are some who even now own shops within the central business districts in the capital Accra and also other parts of the country. Now, these foreign traders actually rely on the backing of the Economic Communities of West African States, ECOWAS protocol, which allows free trade or free movement of goods and persons within member states. But then there is a caveat to that. People from these member states are allowed to move to these countries and do business for a period of 90 days, after which they can go back to the country. But over time, we've seen that most of these foreigners, especially Nigerians, have overstayed their welcome and they are engaged in retail businesses, owning shops. And now traders here in Ghana have woken up to the situation and realized that they are really being affected by the situation and they want it addressed. Now, with what is going on, they've over the time sent their concerns to the government that the Nigerians are pushing them out of business by engaging in retail business, which is against the law, but then nothing has been done concerning that. And this is the second time we are seeing such situation where they are taking the law into their own hands, going about locking the shops belonging to Nigerians and other foreigners who have shops in the country, all in a bid to call on authorities to act and also enforce the law that bars any foreigner from engaging in retail business.
Right. Is there any link, though, between this current dispute and what we've seen along the Nigeria-Benin border, Nigeria closing that border, and a lot of Ghanaian traders have been affected because most of their goods have essentially been stuck there for months now?
Well, there are a lot of Ghanaian traders who are actually worried about the closure of the Nigerian border. But then speaking to them, they tell me this latest action by closing down the shops of Nigerians is not necessarily a retaliation of what is going on at the Nigerian border. They actually want the laws that bars foreigners from engaging in retail business to be enforced. They tell me it has nothing to do with the border closure, as we know that government is working to resolve the situation with the government of Nigeria. But then they actually would want foreigners not to participate in the retail business or also control the retail market here in Ghana. They want to have full control of retail business or petty trading here in Ghana per what the law says.
Right. One last question for you, Nabil. Ghana did win the right to host the Secretariat for the Continental Free Trade Area in July in Niger, was there for that particular event. And that treaty aims to enhance cross-border trade. Isn't there a contradiction here? Because on one hand, the government in Ghana says they want to see a lot more trade across their borders. But here they are essentially looking at foreign nationals from ECOWAS, no less, being prevented from running businesses in the country. I mean, isn't there a contradiction here? What does Ghana really want?
Exactly, Ramah. There is a contradiction to this, but then the latest situation going on is actually an action.
Unfortunately, it seems we have lost that connection there to Accra. Nabil Ahmed Rufai there from the Ghanaian capital. Now, we'll now focus on African cities. It's a series we're working on for a bit of time here. Let's head over to North Africa. CGTN's Yasser Kim has been on a journey through Cairo, a city that is famous for its rich history and culture, and it's one of the largest on the African continent.
Even before you step foot on it, when you see the famous pyramids from up in the sky, then you know you've arrived to Cairo. As you move around, it's evident the capital city has a unique mix of history and culture.
The city under the name Cairo is 1,051 years old. The city itself exists for much longer. It had different names before, like Fustat during the Islamic Fatimid period and the name Aoun during the ancient Egypt. It is home to 3 civilizations: Coptic, Islamic, and Pharaonic. You can find it in the architecture and design of churches, mosques, temples, and houses from each civilization. All these multiple heritages in one city makes it very unique.
There are dozens of museums and palaces all around Cairo. They display everything from arts, architecture, and monuments of diverse cultures and rich history. Like most cosmopolitan cities, Cairo is overpopulated and overcrowded, with about 20 million inhabitants. The government has established small cities on the outskirts of the capital to move Egyptians out of Cairo.
People are already relocating to the modern cities like October City, 10th of Ramadan City, and the new capital. They want to live in quieter, more eco-friendly neighborhoods and at the same time lift the burden of Cairo.
There are ongoing projects as well to develop the city's infrastructure and restore its beauty.
The historic buildings being vacated will be transformed into museums or cultural centers. The rundown areas of the city, including downtown, will be developed into business districts, shopping centers, hotels, and entertainment areas to make it more welcoming for tourists.
Soon, there will also be a new must-see attraction for any visitors to Cairo. It's the Grand Egyptian Museum, the largest in the world and with the most technologically advanced and innovative display of monuments. According to the specialized travel guide magazine Lonely Planet, Cairo is ranked 3rd in the best 10 cities worldwide in 2020. It's forecast to be a top destination for travelers next year. Yas Hakim for CGTN, Cairo.
You're watching Global Business. Time for a break. Here's what's coming up next. Apple has now formally joined the streaming battle. We'll look at their latest offerings. And Singapore real estate investors are worried about the fallout from the implosion at WeWork. Data out of the country. The country's foreign currency reserves.
With a dedicated and diverse team of anchors, CGTN now brings Africa to the palm of your hand.
I'm Perina Karibe in the heart of Nairobi, which is bustling.
From everyday heroes to the continent's most powerful figures, we bring their voices to you.
We haven't changed. And this is something most of us are very excited about.
We bring you news that's changing perspectives.
I'm Ucheoko while reporting from Nairobi City Center.
News that brings Africa to the world. CGTN. See the difference.
Welcome back. These are the stories making your headlines at this hour. Let's start in South Sudan. The country's president, Salva Kiir, says that his government takes full responsibility for the delay in implementing last year's peace agreement. Kiir says that the government lacks funds to implement the required reforms. He says that the best option for the country now is for all parties to the peace deal to adhere to the November 12th deadline to form a unity government. But the opposition leader, Riek Machar, has threatened not to join the new government. He's asking for an extension of another 6 months. Environmental campaigners are warning that Africa's biggest refugee settlement could be the cause of an environmental disaster in northern Uganda. Over 250,000 refugees are living at Bidibidi in northern Uganda, where the struggle for wood fuel and construction material is causing some grievous deforestation. Uganda's disaster ministry estimates that 58% of trees in that area have been destroyed in the last 10 years. And finally, as we spoke about a little earlier, tension is still simmering in Ghana as local traders in the second largest city of Kumasi lock shops up belonging to foreigners, particularly those from Nigeria. The local business owners are saying that their action is to compel the government to restrict foreigners from engaging in the lowest end of the retail sector. Nigeria, of course, has also closed its border with Benin. The argument from Abuja is that that has to be done to curb smuggling. That's a run through your headlines. Now, Apple is getting into another new market. On the 1st of November, the tech giant launched its Apple TV Plus service, essentially its own streaming service with its own original content. CGTN's Mark New has the details.
Some say sight was taken from them by God.
Apple has attracted Hollywood stars like Jason Momoa, Jennifer Aniston, and Steve Carell to star in its original productions. At $5 a month, the Apple TV Plus streaming service is being considered by Fabian Santos, who already subscribes to Netflix and is eagerly awaiting Disney's new streaming service.
I'm an Apple user, and I saw some of the trailers. Everything looks very good, but if you get all the services, it's going to be a lot of money. So you have to choose the services that actually got more to do with you.
There's only 9 shows, and people are used to a much wider variety of choices. So it's going to be interesting to see how people react. Clearly, there's going to be a lot of initial excitement, but how quickly people fade from that is the real question mark.
The lack of content is a major disadvantage as Apple battles market leader Netflix and Disney Plus, which launches November 12th. But Netflix started its own original content 6 years ago, and Disney has its extensive library of family shows, and of course the Marvel superheroes and Star Wars franchises. But with a reported budget of $6 billion, Apple TV Plus has more in store, like shows from celebrity icon Oprah Winfrey and director Steven Spielberg on the way.
They're spending a lot of money on these shows. It's definitely a risky bet. I mean, this is like the music business, the old days of the music business. It's kind of a, you can get a hit, but you may not.
But Apple does have some advantages. It has devices in the hands of more than 1 billion users who, with a few taps, can start watching Apple's shows almost instantly.
A lot of people think this is going head-on against Netflix or Roku. It's not. This is an and strategy. It's a content strategy. Most people are going to subscribe to, at most, 3 streaming services. They're not trying to replace like every single movie known to mankind, or I've got a TV studio that's got an entire library that they want to recreate. They're part of a system where they're one content channel within the Apple TV family.
Apple TV Plus also adds a powerful tool to its arsenal of services. Many users wonder if it will eventually wrap its iCloud storage, Apple Music, and Apple TV Plus together for one low price.
There's a lot of questions as to when they'll bundle those services into a bigger package, or to family plans, or to sharing types of plans for groups. I think that'll happen over time. Apple traditionally takes a very cautious approach. They launch a product, they see how it does, and they figure out when it makes sense to cut over to the next price point.
If they bundle Apple TV Plus together with iCloud and Apple Music, all for one cheap price, would that be more attractive?
It's very tempting. I could even consider changing from Spotify to Apple Music because I'm a Spotify user. So if they actually make like a whole package like that, it's very tempting for sure.
Santos was even more tempted when he found out about an Apple promotion to lure new customers. Buy any new Apple device, and it comes with a 1-year Apple TV Plus subscription for free. Mark New, CGTN, San Francisco.
China's commercial 5G networks were formally launched this week in Beijing at an annual Postal and Telecommunications Industry Expo. It draws attention in discussions to the technology's current state of development and its future prospects in different markets. CGTN's Zheng Yibing speaks to Chris Horton, Senior Vice President at Ericsson.
Well, I think 5G's really taken off, and different to the other 4G, 3G, 2G technologies we've seen in the past. I think we have, this time we have a number of devices before we have as many networks rolled out. So I think there is, things have gone faster this time. There's a huge interest and a huge buzz around those things. And in the networks that we've launched, we've seen a very rapid take-up. People are really interested in 5G. So I think 5G is very healthy. It has a great potential. And I think now over the next few years, we're going to see that potential realized.
What do you think about the development prospects of 5G?
Basically, it changes industrial production, how we can manufacture things in a different way. So it was, real tremendous possibilities across all industries. It's beyond a consumer play. Of course, there will be a big impact to the consumer. They'll have faster speeds, better devices, and new features that we can't even dream about yet. But also, I think the difference with 5G is that it really brings industrial internet. And I think that's such a great importance to China, that China modernize its manufacturing base and its whole industrial base on the back of 5G. And I think that's where the real potential lies for the industry.
Now, here's a thought experiment for you. If you take a stone and you throw it at a building in Singapore's CBD, the odds are pretty good you're going to hit one with a flexible workplace. But the recent WeWork implosion is sending concerns among real estate observers and investors in the city-state who are reeling from the impact of a fall in office property prices and rentals. Here's CGTN's Mirulu with the details.
Withdrawal of its decision to go public, difficulties in fundraising, and departure of its CEO. Co-working giant WeWork has been dominating the headlines for all the wrong reasons recently. This has raised huge concerns in the office real estate sector, especially in Singapore, where co-working spaces have tripled since 2015.
The demand for the last few years, majority of them, between 30 to 90% of the space, actually driven by this co-working operator. If the demand concentrated very much on this co-working and technology kind of space, then moving forward, this may be some adjustment in the market.
Speculations arrive that the troubles around WeWork, coupled with a slowing economy, could hurt the co-working spaces in general. In Singapore, experts have warned that corporate demand has already come down, raising concerns of the sustainability of the current shared workspace model.
Easing these fears, analysts believe that demand from smaller enterprises, cybersecurity, and e-commerce players will continue to support the sector.
I think that the co-working business is here to stay. And I believe they cater to an ecosystem of startups, entrepreneurs. We look at the other co-working operators, especially the likes of D3, the Work Project, JustCo. They have some form of injection of capital or investments from developers themselves, and they come in to offer the kind of flexible space that a lot of tenants need.
Furthermore, the expansion of WeWork, together with other major players such as IWG and JustCo, has been a key demand driver for Singapore's real estate investment trusts. A real estate investment trust, or REIT, is a company that owns, operates, or finances income-producing properties. One primary risk for REITs is that they're subject to real estate market fluctuations. While WeWork's troubles did send some investors into a panic, observers were quick to point out that these companies would be able to manage their cash flow, as flexible workspaces cover only a small percentage of the real estate portfolio.
WeWork may be a bit of an overhang for the REITs in general, but we found that in Singapore, I think the exposure, with the exception for CCT, which is about close to 10% overall co-working exposure, the other REITs are fairly manageable at about 2 to 3%.
Global attention will be on WeWork in the coming months as it tries to get its house in order. But whatever the outcome, the crisis has certainly brought issues within the rapidly growing flexible workspace sector under the public lenses. The onus will now be on the companies to manage their revenue and maintain investor confidence. Mirulu, CGTN, Singapore.
Up in the United States, Halloween is a multi-billion-dollar industry. It's pretty huge, but this year it's not the ghosts and the ghouls that are casting a spell over the haunted holiday. It's actually the trade war between the United States and China. CGTN's Tony Waterman explains how nearly every single Halloween item, from vampire makeup to pet costumes, is in the crossfire of this ongoing trade war.
Welcome to Total Party! Woohoo!
For a few weeks a year, this total party in Arlington, Virginia, morphs into a Halloween headquarters, chock full of the creepy, the cutesy, and the downright cagey. But the spookiness on full display is no match for what's lurking in the shadows.
China, China, China.
China. How many of the 30,000 plus items that you have in the store, how much of that is sourced from China?
95% of all of our SKUs come from China. Predominantly anything that's plastic oriented, all the costume, the accessories, it's all from China.
Nearly every item in Lorenzo Caltagirone's shop is now in the crossfire in the tit-for-tat trade war between the world's two largest economies. Prices on Halloween staples like strobe lights and fog machines went up 15% overnight. Caltagirone says that he was forced to pass that tariff along to customers, but overall, he's been eating the costs.
It does definitely take a bite out of it. 50% of our annual sales happen in the month of October. We're on pins and needles until the very end. So yeah, it has a huge impact on how our overall business is for the rest of the year.
Managing the trade war's impact is particularly challenging for small businesses, which lack the options large retailers use to offset costs. And those already limited options are getting further squeezed this year. The National Retail Federation expects U.S. shoppers to spend $8.8 billion this Halloween, a massive number, but the second consecutive year of decline after a decade of explosive growth.
When individuals feel good about themselves, their jobs, their own income, they're willing to spend a little bit more on the special people or special occasions in their lives. So we've seen some really strong spending over the past several years for Halloween and for other major consumer events.
Most of the money is spent on costumes, candy, and decorations, all of which are subject to new U.S. tariffs. Some customers say they have noticed higher prices, but it's not enough to scare them off.
With all my articles for my current outfit, probably between $150 to $200.
For a good quality costume, you're going to spend between $50 to $100.
If nothing changes on the trade front, some prices could be 25% higher next year. In the meantime, there are all the other occasions Caltagirone caters to. He says prices on those items will go up in January.
We're hoping that the tariffs will be pull back so we don't have to do the hike. But we don't know yet. We don't know. So we're hoping.
Hoping a lasting truce will make more treats than tricks. Tony Waterman, CGTN, Washington.
Right, then a quick run through commodities here for you. So let's focus on gold and palladium, two metals we'd like to really keep a very close eye on here. Gold spot essentially up by 17% so far in the year, and most of those gains have actually started to ramp up from June so far. So essentially June all the way to around August, it really had a strong climb and it's pretty much plateaued ever since then, but it has dragged up miners along with it. Barrick Gold, for instance, share prices up by over 21%. Palladium, though, even on the spot side of the market, they're doing particularly well on that commodity, up 43% so far this year. Here's what's coming up next. We'll take a deep dive into the frontline experience of running a business in Africa's largest economy.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about. CGTN, see the difference.
Welcome back. Let's circle back to Nigeria now. It has improved its ranking on the latest World Bank Ease of Doing Business Index. Africa's most populous nation now ranks at 131. It's up 15 places compared to last year. But the index aside, in reality, how much easier is it really to do business in Nigeria? CGTN's Kelechi Mekalam went to find out.
Yahaya Abubakar runs a printing company in Nigeria's capital, Abuja. And for the past 10 years, he's worked hard to keep it afloat. In spite of costly printing equipment, Yahaya had projected a massive expansion by now, but there have been challenges.
One of the bottlenecks, as we all know as Nigerians, has been the problem of power, energy. It has been hindering the smooth flow of the business. And another challenge again that we are facing has to do with the easy accessibility of loans. The interest rate is too on the high side.
The government in 2016 launched a presidential council to develop reforms that will ease business operations in Nigeria. Since then, the country has seen a steady rise altogether, moving 39 places up on the World Bank's Ease of Doing Business ranking. More simplified business registration processes and an immigration policy of visa on arrival have encouraged foreign investors. Development economist Isaac Botti has been closely watching the Nigerian business environment. He believes the reforms are good, but so much more would be required to have significant impact on businesses here.
Currently, our level of industrial production is at minus 10%, which simply shows that Nigeria is not moving forward in that regard. What about manufacturing? Currently, our level of manufacturing production is at 0.40, which also shows that not much has been achieved. So all that tells us that despite the claim that it's easy to do business in Nigeria, we are not seeing any significant improvement.
Business operators like Yahaya are hopeful for a more favorable environment, and that translates to better interest rates, improved infrastructure, security, and electricity supply. Kelechi Amekalam, CGT in Abuja, Nigeria.
Quick run through the currencies here for you. The rand essentially displaying some of the weakness that we saw a little earlier in the week as we await a decision from Moody's. Are they essentially going to change the outlook on South Africa or not? We'll keep you updated on that particular end of the story. The Kenyan shilling has been improving over the course of the week. It's essentially moved from close to 104 to the dollar. It's now pulled back down to about 103.29 or so in the course of this entire week. But can it continue that streak of gains over the next week and essentially into the end of the year? We'll find out and update you. That's it for tonight's edition, though, of Global Business Africa. As always, we'd like to hear your thoughts on the content you've seen here in the last hour. There are many ways to get your thoughts back to us, all of them on your screens right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. Thank you for your company in the last hour. The world today's up next from Washington, D.C.